back to FinSense. In the last video, we have covered the basics of bonds. And if you are new here, I would highly recommend watching that video first to understand the basics of bonds, the key terms used there, and the relationship between a bond and a yield, bond price and a yield. So, because this concept will be built directly based on the one that we discussed in our earlier video. So today we will answer a very important question: how bonds pay you. So basically the cash flow structure of the bonds. So these can be divided into majorly three cash flow structures, that is a bullet structure, fully amortizing structure, and a partially amortizing structure. So let's take an example. Imagine you lend your friend $1 lakh and they said that I will pay you $5,000 every year, and after 5 years I will return your full $1 lakh, right? So let's structure it. So the loan is of 5 years and the cash flows generated would be so your friend told you that every year he or she will give you 5,000, and at the end they will pay you the whole amount, that is of $1 lakh, right? So in this case what you are getting is a regular income of 5,000 every year, but the main amount comes at the end, right, in the 5th year. So this is known as a bullet structure, that is a very commonly used in the government bonds and the corporate bonds. Moving on to the second structure, that is fully amortizing structure. The best example I can give you for this is a home loan. And home loan comes with the EMI that we pay every month, right? So now think about that home loan. Every month you are paying some EMI, right? So let's take an example here that the loan is of $1,000 at the rate, it's a hypothetical example of a very less amount of 1,000 loan, just to understand it clearly, and the rate is 5% and the time is of 5 years. So let's take the EMI around 230, that is a approx value. Just for our discussion we are doing this. So this is the terms of your home loan. Now in year 1 what is going to happen is, what you will be paying is the EMI, right? But exactly what is included in this 230 are two components. One is interest and the other one is the principal repayment, right? Now what would be the interest part of it? So interest would be like the loan we had was of 1,000 and the rate was 5%. So the first year the interest would be of 1,000 into 5%, that is $50, right? So what would be the principal then? Principal would be the balancing figure, that is 230 minus 50, that comes out to 180, right? Now in the year 2 what is going to happen is, the loan that was initially of 1,000 we have already paid 180 in that, and now the remaining loan would be of $820, right? Now this year also we will do the same, we will pay a EMI of 230, right? And in this 230 we have again the interest and the principal part of it. Now very important thing, now the interest would not be on 1,000, it would be on the balancing loan, that is of 820. So 820, 825%, it would be the interest amount, and that comes out to approx $41, and the balancing again would become the principal. So balance would be 230 EMI minus the interest part of it, that comes out to approx 189. So this is what we have paid, and so on it happens. Like in the year 3 again the same thing would happen. Now the loan would be of 820 minus 189, and the loan would be remaining only of 631. So this is what is happening year on year. The loan is getting reduced, as well as the EMI part remains the same, but the component in the EMI interest was somewhere 50 in the first year, and it got reduced to 41, and the major chunk is now going towards principal as the year on year we are calculating it. So this is what happens in a fully amortizing loan, that in the beginning you are mostly paying the interest, and over time you are actually repaying more principal. So even though the payment of 230 remains same every year or every month if we are considering EMI, but the loan keeps reducing and the interest burden keeps falling. So this is the whole concept of fully amortizing structure. Whenever the fully amortizing structure is discussed, just consider the example of EMI, and it would become very easy to understand. Then the third part we have is the third topic of the cash flow structure is partially amortizing structure. So in this case, let's imagine that we started a new business. In the first few years, what would happen is our income is limited. So we will prefer that a loan having a smaller payments in the beginning. But in later, as in when the business grows, we can afford large payment. So we want a loan to be structured such that the small payments are now and the big payments are later. Right? So we will need a combination of both the above, like both the above structures that we discussed. So it is the bullet structure and fully amortizing structures combination is a partially amortizing structure. It has both the features of both these cash structures. It is also called as a balloon payment, because there is a smaller amounts getting paid every year, and at the end you will pay a big chunk. So that big chunk is known as a balloon payment. So let's take an example for this. If the loan is of let's say $2,000, interest is 5%, time is 5 years, and the annual payment is of $300 approx. Let's say the balloon payment at end is of $800. So this is the new feature that is added, and based on that the annual payment is decided. So now year on year the same structure will follow, that we will pay 300, some amount will go to interest and some will go to the principal, and this loan amount will get reduced over the years. But in this case, at the end year, the 800 balloon payment, so the end year, that is our fifth year in this case, we will pay 300 because that is our annual payment, and we'll also pay 800. So this is the balloon payment that we are paying, and this is a partial amortizing structure, majorly similar to the amortizing structure, but with the provision of a balloon payment that is linked to a bullet structure. So these are the three commonly used structures. So today we understood how bonds actually pay you. Either it is a bullet structure. In the bullet structure, a full amount at the end is paid. In the full amortizing, a gradual repayment, and in the partially amortizing mixture, that is a mixture of both of these things. So these concepts are very important before moving to the different types of bonds and the calculation part of the coupon rates and bond pricing. So in the next video, I will be covering different types of bonds like the floating rate bonds, inflation linked bonds, and more. Thanks for watching this video, and if you got a good idea of these structures, do like and subscribe to the channel. Stay tuned for the next video. Thank you.